So now we turn to the refined products and a little bit more of a deep dive of where is current demand, where do we think it's going, and where does COVID obviously fit into the underlying backdrop. So when we look at just what is currently, and again, this is more looking at the gasoline, jet, disti, and residual side. So the current net is 13.56 million versus last week's 13.841. Again, holding that average at that 13.84. And as we keep talking about that, we'll keep seeing this start to normalize a bit more closer to that 13.5 or so, just as we go through kind of the remainder of the year, I should say over the next few weeks. And here you can see we normally get that increase when we look at 2020, 2019, 18, 17. We normally see that spike going into April, and then we hold that level when you consider just spring, people moving around, going to parks, doing more things in general, that you normally see some of those increases. Because of the shifts that we're in, we're going to see that move up to the next level, and we'll most likely get to about 14.5 or 14.7. We're going to start to close that gap, but it's going to be on that seasonal norm, and we'll see that happen more on the Easter break push, because we've already had our spring break. Now we're going to get the Easter break push, and that'll kind of put us to the next level where we'll see that hold over the next few weeks until we start getting into summer driving. And then we'll start to close that gap a bit more as we go into that part of the year. But again, this is looking at everything. This is looking at jet. This is looking at distillate. And this is where we continue to see some of this friction in terms of what is the narrative in the market versus what is the data actually showing us. So then when we look at just in general what is happening, distillate had a big build of 3.81 million. It was pretty much across the board except in pad 4 of a small draw. You could see the big about face, even though we typically see a drawdown that normally lasts until about April 5th or so, or the first week of April. So now we're 17.1 above the year over year, 1.8 million above the 5-year. And it's been, as we were talking about and as we keep talking about, there's just a massive amount of imports. So here we had another increase of 140,000 barrels a day, taking us 549,000 over the year over year and 531,000 over the 5-year. And it was really driven by Pad 1. Pad 1 continues to see a pace of imports. And just based on the new kind of calculations of ships coming over, this is going to remain elevated. So we're going to continue to be and see those increases. We did get an increase in exports, which was a bit surprising. I thought we were going to see a drop, but we did have a delay at the beginning of the week. And it comes down to those timing issues. And, did somebody give some sort of discount to try to get some of this off the coast? So there's always that competition that's going to remain, but we're still going to average further to the downside as we continue to see this push higher, just because that heating demand went away fairly quickly. And we just based on the temperature side, we're not going to see too much, while diesel demand on the trucking and the rail side will remain robust in general. So when we look at just supply demand here, the demand side, you can see that it really dropped down along those seasonal norms, but it's continuing to fall further down. There will be a spike back because there's always that timing delay. It's just we've already refilled the heating oil side, so there's really no need for that next push. That's what this spike up was. And now we're starting to get into more of a post-heating oil side and more of a driven based on diesel demand. What are toll roads saying, which remain elevated when we're looking at the trucking side. But again, these are some of those impacts. Now, we did have refiners targeting a bit more disti. And, with production up by about 373,000 barrels, we had production on the gasoline side actually down. That's something that will start to reverse. It's just a matter of when does that happen. And when we start talking about blending components, even though the gasoline build was fairly small, it was still a build, which was unexpected. It was a matter of just the blending components had a very large build, which will explain why that's important. On the trucking side, we continue to have some of those issues in the Midwest with some of these late season snowstorms, which is keeping us elevated in general. You can see that we're still well above the 200 level. This is something that, again, as we keep talking about it, it'll keep drifting lower. It's just a matter of there is a lot of trucking demand out there. I mean, anybody who's been on the highway, freeway in general, can attest to the fact that there are just a lot of trucks moving stuff. And when we go through the econ show, we're going to talk more about, those logistics, those timing delays. So inventories in general still remain low. So there's still going to be a lot of reason to see an increase in not only rail intermodal, but also this trucking demand in general. When we look at rates have really kind of flattened out. They've, because we did get a pullback in oil prices, we did see a slowdown in how quickly the gasoline and diesel prices have gone up. I know from personally and just things that I've seen in data sets, there were the diesel surcharges that hit from February and March. So the first week of March, a lot of individuals got hit with those diesel surcharges. So we're not going to see the next level because right now we're starting to peter out. And when you look at what makes up gasoline prices, oil is a piece of it, but it's also what makes up the gasoline itself. And as we get closer towards Memorial Day, which is where we get that heating, the shift into summer grade, that's when you always get that increase in pricing. It could be anywhere from 15 cents to 25 cents, depending on the cost of octane at that point in time. But there will be that shift. So right now, we're kind of just flattish at this point, given where some of these prices are as some of the prices start to cool off and flatline. Now, as we talked with on the rail side, net car loads were up 2.9%. Chems were down. That's something that will continue to reverse a bit as we get that elevated pricing in poly and PVC. So that will be supportive. On the grains and forest product side, again, can't stop, won't stop. We have record exports. We have a record amount of demand. Pricing is robust, so there's a lot of reasons to keep that going, which is something that we're going to talk about in the econ show. When we look at motor vehicle, non-metallic, as we've been saying, those are going to see some headwinds as there's just those disruptions. And it's not even so much on the steel side, it's just the availability of technology, microchips and the like that continue to be the problem, which is going to really hold that back. And then the petroleum product side, that's going to continue to be a net headwind in general. We're starting to get closer to easier comps versus 2020. But again, those are things that we're just not going to see increase to the same level. Intermodal still remains at 19.8% versus 2020, still elevated in general. It's going to continue to be elevated versus 2020. It's just when we think about going back a bit further, trying to normalize it versus 2020, we're still going to see a robust move because even 2019 was weaker. But again, speaking to why we were concerned about 2019, but we're still going to maintain these upper single digit numbers. As intermodal units continue to move through, we start to see some offloading at the coast, some of those bottlenecks moving through, trying to just refill some of those inventories. Some of the data on durable goods spending, some of those are going to help backstop, allow a little bit slow down on buying, increase some of those inventories. There's obviously a lot of weather impacts as we look at February and the freeze off. So again, those are still some of those residuals that will remain, but again, things that will be robust going forward. Now, when we look at the Port of Los Angeles, when we look at week over week, we're starting to get some of this normalization on just the volumes in general. As Pad 5 continues to their reopening, this will start to streamline a bit more. There's still that huge bottleneck on the coast. And when we look at the previous years and just the amount of ships in waiting, but the volumes are continuing to move up in general and getting a bit more streamlined. Instead of having import volumes expected in the first week of April at 800,000 or this stupid crazy number, it's now getting very stable at 140,000, 145,000, which is showing a bit more normalcy, which will start to show up in trucking and rail as well. The other issue is we continue to see PPI pricing and the cost of exports going up out of South Korea, China, which again is going to just keep our import prices elevated in general, which will be a net headwind. So when we just rounding it out, when we look at just weather in general, you can see it's pretty stable. There's not too much away from what should be happening in early spring, which is just going to, again, kind of cap the heating demand for anyone out there enjoying the 60-degree weather. We are as well. Windows are open, heat is off. These are things that are just comfortable, but it's just going to kind of cap off not only just heating oil, but obviously natural gas and that tail end propane demand for outdoor dining and indoor, fireplaces in general. So now shifting over to the gasoline side. So here you can see gasoline had a build of 200,000 barrels. It was really driven based on pad 1, 2, and 3, where pad 3 and 4 had a little bit of essentially small builds, and then pad 5 had the biggest decline of 610,000 barrels, which makes sense when you consider the refilling of assets. So when you look at, and I know I say this all the time, but when you look at just the aggregate way it's calculated, you have the actual storage tank, you have the pipelines themselves, then you have it in the racks where it gets blended, then it's from the racks to the end user. So there's always different choke points and there's different points of measurement, which is why we've been very adamant about the fact that we were going to see that drop off in demand, just because some of the demand was a bit front loaded. You had some movements through, and now you're going to see some of the residual kind of remain as we get some of these delays on when there's the refill. And then on the other side, we continue to see an increase in imports. So we pushed closer to 1 million barrels a day. We were up 29,000 barrels to 939,000 a day. That's an increase over the year by 106,000, 5-year by 310,000. That will remain, and the tail end. So when you look at what is coming on shore, we have more coming into pad 5, so those imports will increase. But we also have more coming from Europe. So we have this most recent week, we have a big push in diesel. And then behind that, we have a pretty steady increase of gasoline. So we should see a dip in imports and then a spike back up in gasoline imports, which will make some of the numbers a bit wonky. But that's what these guys were preparing for. With that dip in production, the production was going to ramp back up to essentially trying to play this game, as you can see here, which is why we keep talking about the seasonality side. We continue on. We normally see a decrease in storage through May, and then we get a little bit of a bump as we get that push into Memorial Day, then a little bit of a slowdown in June, and then obviously the run up into July 4th. But when you look at this on the aggregate, we're still down 7 million barrels over year, down 8.2 million barrels against the 5-year. But given the amount of product in the world, we're going to be the dumping ground given where the arbitrage is, as we outlined last week in segment 1. This is going to continue to attract gasoline into our market, especially as we look at pad 1, pad 3, and pad 5. So again, that's going to push us further up when we look at the storage side of the equation. Now, on the demand side, GasBuddy does a great job of calculating and really giving us some color. You can see that we've had a very steady increase in demand, which when you think of it against the seasonal norm, because obviously last year was a unique year, typically when we start going back to 2019, 2018, 2017, this is when we normally start to see that marked increase, but again, it's still a positive in general. So they had us with an increase against the closing week, an increase of 5.9%, which you can see here. Now, when we look at Descartes, which is using cellular devices, they had a small decrease of 1%, and that totals for them at 9 million barrels. So when you look at what GasBuddy has said, which is closer to that 8.9, Descartes is about 9.1 million. There's that delta because how many things are in this, how many cell phones are sitting in the car. There's some noise that can come in, and then GasBuddy is looking at what is happening at the pump based on people using their application, and then extrapolating that out. And they've also have now looking at EIA demand data, which has been very strong and correct in general. So again, there's that means of calculation, but it still shows that there is an increase in demand. It's just not closing the gap against where we are. It's just moving in lockstep with seasonal demand, just at a shift, a standard deviation down. So when we look at gasoline prices, They did go up on a national average. Again, you can kind of see how slow. We had that big surge, and now we're starting to get some of this normalcy as we get some of that gasoline demand falling a bit or normalizing a touch. And then, with that preparation for that push, same thing happened in diesel. Diesel was pretty much held, constant for the most part at about $3.19. U.S. gasoline about $2.86. I don't see us getting to 290 especially this week or even into next week as we get some of that slowdown, and then we'll get that next bump up when we start getting towards that summer driving. Now, blending components is where we continue to look and try to understand what is happening. And here you can see that we actually had an increase in storage, and we're still at the elevated level. So refiners were preparing for summer driving season back in February just because there was no real money in winter. They had more than enough to satisfy. So they started making these blending components. So that's where we're continuing to see some of this friction, where even though gasoline only had a build of 200,000 barrels a day, 200,000 barrels, blending components were at 1.34 million, and is much closer to that year over year and 5-year average. So again, it's kind of that push point. Gasoline demand is tracking where we were in 2012 and 2013, which were fairly slower years, and you can see that we're still well off of pace in general. And then just pulling this back a bit and looking at what is happening, this is looking at 16, 17, 18, and 19, obviously stripping out 2020. Because this is the point where we started to see that big drop off, and you can see that we made a higher low. We're right here we're kind of meandering, but we will get that push up. And if you just look at 2019, how we had something similar where we had a little bit of a pullback, kind of went sideways, and then we had that big surge up, and that's going to be when is Easter. You can see it's kind of off by a week or so, depending if you're in 19, 18, 16, 17 was a bit, of an odd year just because it was a bit late. But again, that's why, we expect to see that increase as we go into the Easter season. Looking at propane, we're starting to flatten out a small build of 240,000 barrels. It's something that's going to continue to kind of flatline and then go up, as you can see from that normal, where this is where we kind of normalize, then start to see some of those builds. Obviously, production increasing with the amount of spreads, especially in some of the liquid areas, is starting to see that increase, which will help push this closer to that 5-year average. Now, when we look at case count and whatnot, and just what is some of the activity in the U.S., we're starting to see a small increase in cases, which is not overly surprising. As we've been saying, we kind of expected this last little surge in cases. Obviously, we've been saying it won't look like the others. We won't see the same type of hospitalizations because we do have people vaccinated. We do understand what we're looking at now, but we will see kind of that continued move up just at a very steady pace, especially if you look at Michigan, based on the variants that are now moving through, that's going to keep us fairly elevated, but not at, 800 to 1 million or so. It's going to be, are we at 385? Are we at 410? That's going to kind of be within this level. And that's going to keep the lockdown index moving in a positive direction. It may delay some further reopening, but it's not going to make us go backwards. So that's going to be a net positive in general, just as we look forward. And I just wanted to show this because this is what we keep talking about. And we have a segment again on work from home and some of those key data points. But when we look at mobility, we keep talking about how the weekends are going to surprise to the upside. So we expect to see 7% above year over year when we look at weekend, where weekday, we think we're going to still maintain a down 20 to 25% just because people still aren't going to the office. And even if you are going to the office, what if you're vaccinated? Are you more comfortable taking mass transit or less comfortable? So how many people will stay in their cars versus going back to mass transit? I think it's going to be a very slow adoption back into mass transit. So you'll still see that elevation, but just anecdotally, and then obviously this data supports it. People I've spoken to, we've put out polls in general. A lot of individuals are saying that they've been told they're not the corporation isn't going to reopen until October. Some individuals have had their companies let their leases lapse. And then you have some that are saying, no, we're already back. So it's going to be that bifurcation. And then the more and more commonality has been, no, we're doing a flexible schedule now. We went from full-time, more flexible. So again, that's going to be that headwind on that Monday to Friday as we continue to see, when we look at Sunday, we were at that high. We were actually positive. Saturday was a small dip, and this is, the March 6th. So we're still going to trend in the positive direction. And that's where we see some of that longer term headwind, which is, again, playing out here. When you look at, that spike in parks, when is it? Weekend. But then we see that transit stations, people are starting to go to the transit stations a bit more, but workplaces haven't really done much. So again, we're not getting the reopening. People are like, this traffic kind of sucks. I'm vaccinated. I feel okay being on mass transit maybe 2 or 3 times a week. So that's where we continue to see some of that kind of that bifurcation on that recovery. Now, when we look at trends on Apple, you can see that we've had a steady increase in the US. Again, this Apple is calculating based on how many times or what you've searched for. So if you sit there and search 3 times for something but only drive once, that's going to calculate 3 times. So just to give you an idea, because I know I'm guilty of that to check traffic. So this is something that is a bit skewed, but it's still moving in the same trajectory that we would expect, where we're getting that shift down in the Italy, UK, Germany, and kind of that flat line. Italy's moved down, France has moved down, again, weighing on some of that European activity. Now, this is just looking at COVID cases in general. The world has, on a worldwide level, we've seen a bit of an uptick that's really driven by LATAM, Europe, and Asia. The U.S. has seen a small uptick, but again, very minimal. It's nothing like what we saw coming into January. It's going to be that steady decline, a little bit of a bump, and then continue down. Europe is the one that's seen that stickiness. Same with Asia Pacific. Those two, again, are where we continue to be concerned on some of that near-term oil demand. And then when we look at what is driving that, well, India's seen an increase in cases. Mumbai has posted one of the larger ones. You can see Germany continuing to remain elevated. Same with France, Italy, where Japan and South Korea just kind of can't get past this movement, which, again, is just going to keep them cautious. They've opened up the country a bit more. It's just going to keep them cautious while other parts of Asia and Europe remain difficult. Now, what is going to keep them locked down or at least concerned? It's going to be vaccinations. The U.S. had another uptick. Last time I showed this, we were at 0.7. We're at now 0.75. So we continue to see the acceleration. But the bigger issue is when we look at Italy, France, Germany, Spain, just Europe in general. And, India is still at the bottom as well. We continue to see those issues, which now with AstraZeneca, they stopped it. Now they're starting it again. Now there's friction on who can export it to who. The U.S. has delayed the rollout of AstraZeneca, but we already have Moderna, Pfizer, J&J. So it's not like we're going to see a huge impact. Obviously, it's nice to have, 4 weapons instead of 3. But this is, again, going to kind of keep some of the movements capped in Europe. And then the question has come, well, what does AstraZeneca protect against some of the variants? And if it does, by how much? Where the other ones, we know that they are a bit more effective versus AstraZeneca. Again, these are small things, but still moving in the right direction. Jet fuel in general, and this is what I keep talking about. There is a difference between more departures and load capacity. So we saw the spike ahead of spring break. Now we've normalized. We've kind of flatlined here. We'll see another spike as we go into Easter break and into another surge. We had a small increase in jet fuel builds of 490,000 barrels. Again, as we've been saying, we think we're just going to continue to go sideways within this range, just because we're not really seeing that big uptick in just departures that would require more jet fuel. Now, when we look at departures on the aggregate on a global level, you can see China normalized a bit more, though they did announce 10 new cases. Is it 10? Is it 100? Your guess is as good as mine when it comes to China. But you can see that we did get a dip in U.S. Departures. Same with Europe as some of the lockdowns increased. Same with Asia. Same thing with the lockdowns increasing. So that's going to kind of keep some of that additional demand capped in general. But we did get the Middle East and China with those increases, which did offset the declines in the U.S. as departures were up 6% year on year at the airports as that are being tracked based on China. European airlines lowered the number of flights scheduled for May by roughly 12%. And then flights in the U.S. have been stable through May. So this last decline is kind of, we're going to see a little bit of an increase in April, but May we're not seeing too much even as TSA passengers have increased, we've still seeing them move along that seasonal trajectory. And as we had been saying, we were going to see that spike and then kind of flatline. And here's where that flight line comes. We'll get another push higher as we obviously that Easter move, but we're not going to close that gap back to that 2019 level, just to kind of look so you can see where we sit right now. We're going to now average closer to probably, 1 million to 1.3 million as we start to go through, just because we do have a bit more activity. People are vaccinated. Some of the more, those with deeper pocketbooks can fly a bit more than others, but there is that bifurcation as to who is flying, as the corporate flyer really hasn't come back yet. But when we look at seated open table, continue to move higher as we keep talking about. Now that we start getting into these levels with the extension of lockdowns in Europe, we think it's going to continue to flatline here as the U.S. continues to close some of that gap. And what does that mean? So when we look at global, the weekend continues to be stronger, driven really mainly by the U.S. The U.S. has seen a big drop. Mexico's been strong as well. Canada, Germany, Ireland, UK, those will remain a bit limited, but we continue to see an increase now. The weekend is averaging about 20% down below normal, with the weekdays at about 35%. That's a very healthy number. Given some of the pauses on additional restaurant capacity, we think we're going to pause here for a minute, but again, still that net positive in terms of just that activity in general. And as we start to see some more normalization, it's going to be important to look at, well, what are the refiners doing? So what does their import look like? And then how can we import refined product for cheap? And right now the answer is yes, which again is going to keep us being this feeding ground for this kind of floating cargoes that are just bouncing around, that are just looking for a home. So hopefully we can continue to absorb this to see some of the benefit, but as prices go up, that's going to hurt the consumer. So again, you're going to have to see how much new inflation can the market really tolerate before it starts to reject it a bit and we start to see some of that pullback. So in the next segment, we're going to look at, well, how much floating product is out there.